Good evening, everyone. I think there's a few
Uh,
people still entering the chat, so we'll give them a minute or two.
Hi, good evening.
All right, I know we're starting a little bit late today, guys. We're having a bit of technical difficulties. Francisco, are you good to go?
Yes, I am.
Amazing. I see some people entering the chat and responding. Hi, Kathy. All right. Good evening, everyone, and welcome. Thank you so much for taking the time out of your evening to be here with us. I know life gets busy, so it truly means a lot that you choose to spend part of your night investing in your future and your knowledge. My name is Caitlin Hartley, and I'm a realtor with the Carol Foddick Real Estate Group at Signature Elite Realty. I'm passionate about helping people make smart real estate decisions, not just during a transaction, but before, during, and after the move. Tonight's masterclass, Life After Purchase, the real cost, strategy, and opportunity of homeownership, was created because so many people have had questions that they've brought to my attention about buying, owning, refinancing, affordability, timing, and what truly happens after you get the keys. Those are real questions and they deserve real answers. This evening is not a sales presentation by any means. It's meant to be an honest, practical conversation where you can learn, reflect, and ask questions in a no pressure environment. And I'm also very excited to be joined by someone I trust and highly respect, financial advisor and expert, Francisco Lazarte with Lazarte Mortgages. Francisco brings a wealth of mortgage expertise and a real world financial insight. And together we hope to give you clarity around both the real estate side of things and the financing side of homeownership. Whether you're a first time buyer, current homeowner, investor, or simply curious about your next move, tonight is for you. This will be an opportunity to ask questions. And by the end of the masterclass, you'll have a chance to put your questions in the chat and we'll unpack it together. In the meantime, feel free to keep yourselves muted, and there will be some polls that you can interact with on some exciting topics that you may or may not be familiar with. So thank you again for being here. And Francisco, let's dive right in.
Let's go. So again, thank you guys so much for joining this seminar. So let's go into the first slide. So we already did an introduction about ourselves, but I'm going to do one as well about myself too. Um, Again, thank you so much for everybody for joining. I'm a mortgage agent of level two. I've had many years of experience working in the field, helping hundreds of families. I'm very blessed to help with. A little background about myself. I've worked at TD previously to this, and then I was able to fund Lazarte Mortgages, where we helped, again, hundreds of families. And last year, I was very proud to win the top 1% performer in Canada. So we've helped many, and we're going to continue helping more.
Awesome.
Let's talk about the topics of the day. So we have a few topics that we want to go into. So today we're going to be speaking about today's housing market. What does it look like? Rates, affordability, market trends. We're also going to be talking about what qualifies a first-time home buyer, government programs, financial readiness, new mortgage slash existing mortgage tips, purchase success stories, which is actually my favorite slide. What happens now? Renewal tips and the Q&A.
Awesome. Before we get into this, there is going to be a poll that does come up. So when you guys have a second, maybe we'll give everyone about a minute. Feel free to put your answers in. So the question is, what best describes your feeling about the current housing market? Be curious to know where everyone's at.
I'm super excited.
I was going to say, it looks like we have a bit of a tie right now. Ooh, okay. Well, it seems like a bit of both. Excitement, a lot of opportunities, nervous, uncertain. Let's
Okay.
figure out what that all means for everyone. And hopefully by this slide, you'll have a better understanding as to where everything's at.
Yes. So,
So,
okay.
yeah, go for it.
We're going to speak about today. First, the first slide is going to be about today's housing markets. We're going to talk about the rates, affordability, and the balanced transition market means. So right now, I want to give everybody like a snapshot of what we're seeing as rates. I actually put the three most popular rates that we've been seeing in the market. Three are fixed. The lowest insured that we've seen right now is around 4.11, to the highest of a conventional 4.24. I also put in 5-year fixed, which is a 4.35 insured to the highest again of 4.59 conventional. The variable we've been seeing a lot of success and actually a much lower rate at the 3.5 to as high as 3.85. Now, what are the trends that I've been noticing with
Well,
most of the mortgages that
sorry
we've
to
helped
cut in,
with?
Francisco. I was just going to ask, so just for people that maybe aren't aware of insured versus, conventional, can you just quickly give our audience a breakdown as to what either of those mean?
Absolutely.
Yeah.
So there's pros and cons with both. It all depends on the individual that's looking to purchase a property. So, I'll give the pros and cons for the fix. So, with a fix, the pro is you have that stability. You're not going to have any fluctuations in when you're a homeowner, your payments are always going to be the same. That is a benefit for a lot of people because it gives them peace of mind. Whatever happens outside the world does not affect their house, and they're able to pay down the mortgage peacefully. I guess a negative of a fix is the same thing that I mentioned as a pro, that you're not able to take advantage of the market if there are swings, if the rates are coming lower. And one negative of a fix is that if you did want to break the mortgage, the penalty to break it is significantly greater than it would be as a variable. But all you need to know is a fixed, steady payments throughout the whole way.
So I
Then
was
there's
going to say, insured versus conventional. Is that what you're referring to?
for the fixed and variable.
Oh, okay. So insured versus conventional for fixed, for instance, that you put in brackets, what does that refer to?
Well, the insured, what that means is if you're putting less than 20% down, then that is allowing you to access lower rates. Why is that? Because now you're putting down a lower down payment and you're taking on insurance from the government, either CMHC, Canada Guarantee, and that's going to be implemented into your mortgage. So they give you a lower interest rate
Oh,
because of
okay.
that.
Awesome.
When you
I
do,
didn't know
when you
that.
do a com, yeah, when you do a conventional mortgage, that's when you do, that's when you're putting 20% down, that there's no insurance from the government. The government doesn't get involved or put in any CMHC. The rate is slightly higher, but because you have 20% down, it actually balances out for each other.
Oh, okay.
I wanted to speak about the variable as well because I spoke about the pros and cons for fixed. For the
Mhm.
variable, I personally like the variable a lot because it gives a lot more flexibility for the homeowner. An example is, again, you're able to fluctuate with the market. You're able to take advantage of the swings, whether the trends are up or trends are going down. If you look at a historical picture, maybe in 20 or 30 years past, variable has been the favorable rate over time. If you're looking at the most recent years, we did have major swings in the variable, but overall, homeowners that did take variable have been able to pay less interest in the long term. Another benefit of a variable is that you're able to switch to a fixed at any point without a penalty, which is massive. So
Yeah.
you're able to really take advantage of the market, see what the swings are, and if you feel comfortable, you're able to switch and lock into a fix. So I think that's really neat. Um, the last benefit is if you do decide to break your mortgage, it's only a 3 months penalty interest compared to a fix that's much greater.
Yeah.
Um, so those are the benefits there.
Yeah, I think it's important to note like your comfort level, right? So where that that your interest rate on a variable may be going higher or in the reverse going lower, when it is uncomfortable, and then when is the best time to lock in, right? And not just constantly riding out the wave in a sense. Would you
Exactly.
agree?
No, you're
Yeah.
absolutely right.
Yeah.
And I always say at the end of the day, it's supposed to match your personality. It's supposed to match your lifestyle. If you're not comfortable with the swings in the market, even if the rate is much better in a variable,
Hmm.
still take the fix because that is going to give you much more peace of mind. If you're not someone that stays up to date with the market, you're not really invested, or you may not show too much interest in what's going on. Again, fix might be the better option because it smooths out that whole ride and makes the home experience much better for you.
For sure.
Okay, well, let's talk about affordability, buyers, and market shift. Um, the affordability advantages right now, I'm seeing a lot of opportunities for buyers, not only just buyers, but also if you're looking to buy a second property, investment. Why is that? Because yes, the rates are higher, but that means the prices are still slightly lower. So the advantage of you coming into this market means there's less competition, more negotiating power, and access to properties with a much stable price. We're not looking at inflated prices as much at this moment.
I think
How do
this,
how
sorry, I was going to say this also goes back down to like being able to pay off your mortgage quicker, right? And
yes.
higher rates, I would preface where we are now. Would you say, Francisco, you're seeing, 4%, low 4%, high 3, in a market where pre-pandemic we're talking, this would have
Mm,
been expected as well, right? So is it
yes.
higher interest rates or are we at, normal, interest rate territory right now, which has given us as a marketplace for most of the Greater Toronto Area the ability to, as you mentioned, negotiate a lot more off of the purchase price, have more conditions accepted in your offer. And on top of it, because the price is lower in the purchase, you can hopefully pay off your mortgage a lot quicker.
Yeah, I think you nailed it on the head because you're absolutely right. So, like we pre-pandemic, we have been comfortable seeing these rates. I think during COVID time, it really did change the rate environment for us and seeing that much lower rates, we got really comfortable with that.
Yeah,
Nevertheless, now that we're seeing much lower values and the interest rate is going back to what they were pre-pandemic, the people that are able to see what we're going through the market can take advantage of these opportunities for sure.
agreed.
And that goes to next of who's the buyer? Who's buying right now? So like we said, end users that are leading the way, first time home buyers are confidently entering. So this is a key point because even first-time home buyers are feeling like they want to enter the market. Myself and my team, we have been seeing a lot of pre-approvals, much more than we have in the previous last year. And why is that? Because people are getting a little bit more excited with the market. They're seeing much more opportunities. They know that this is a market that represents them as a buyer. And allows them to have more control on what they're looking to offer. Then the last topic there was also the regional opportunities. The different regions are now there's much more advantages with the values because the values have come down to a stable value that it should be, and you're able to be much more picky. You can put more, you can have more control in your offer, and Kaylin can help you negotiate a lot better the purchase price.
Yeah, I think the only other thing I would mention in terms of affordability, the market shift, um, in the last 12 months, and if we're looking at lagging indicators, I think everyone that's on this call, they may or may not be familiar with the Toronto Regional Real Estate Board stats that get released monthly. The last one that came out, which is about 30 days after the effects have taken place to our marketplace. So things could have changed very well since then, but ultimately the sentiment of that report was that we saw an uptick in the amount of transactions happening compared to last year, which does not mean it's now suddenly a seller's market. It's just more transactions happening, better weather, spring market. The buyer sentiment obviously is changing slightly. There's more confidence. And
For
then we
sure.
also saw an uptick in the, well, I'd say values, but only about 1%, which isn't much. Like if you're looking over the last 12 months and a property value went up about just under 1% on an average, you haven't lost much traction in the market. If you're wondering, like, now am I priced out of this area? Probably not, which is also great.
Yep. Yep. And this leads us to what does a balanced transitioning market mean? So this means the market shift. It's a great time to be a buyer. Now they have the upper hand when you're looking at seeing can you jump into the market and can you find a nice property that's suitable for you? What does this again? What does this mean? You're looking at inventory to choose from less bidding wars that we've been seeing from our side and real negotiating leverage for both the price and conditions. Lastly, the opportunities that we've been able to find have been much better. So a client that maybe um, looking to a specific property may be able to actually purchase them in this type of market because there's a lot more to be picking from. So this is why I find that these are great opportunities right now. Okay, very excited about this. What qualifies a first-time home buyer? Um, I like to look at these four things as the main stuff that helps us to determine if you qualify as a first-time home buyer. So number one, the 4-year look back rule. What's that mean? If you haven't purchased a property in the last 4 years, that means you or your spouse or anybody else that you haven't lived in those properties, you are eligible as a first-time home buyer. Okay, so sometimes people think, oh, just because I've never purchased a property, just because I did purchase a property before, I wouldn't be eligible. Not true, actually. As long as you haven't lived or purchased one in the last 4 years, you're eligible to qualify as first-time home buyer, which is great. You're unlocking key benefits as a first-time home buyer. You get access to the first-time home buyer savings account, the RRSP home buyers plan, and the first-time buyer's tax credit, which is great. And as well, the closing costs that helps you with the rebates, which is huge. Like that's a lot of savings right there. Lastly, as well, that I wanted to touch on was the down payment privileges. As a first-time home buyer, technically, when you're going to live in the property as a homeowner, have it homer, home owner occupied, it will be as low as 5% down payment. And again, you can use your down payment from the savings that you built in your banking account, first-time home buyer savings account, RRSPs, home buyers plan, and any more. So I think this is great when it comes to
I just want to
qualifying.
speak on this topic because I know it's a big one for a lot of people. It's can I buy with less than 20%? I mean, the proof's in the pudding. I've had clients that have bought with as little as $18,000 in their account, believe it or not, in this market. Now, depending on what you're looking for, what you are purchasing for, that is all relative to what you need to have in terms of a down payment. But 5%, I definitely agree, is less daunting than 20% down. No one's sitting with, six figures in their account just because they've saved all that money over the years, unless you're very fortunate. But I have had many conversations with parents of friends that have assisted with gifted funds. And I know it's a conversation many people feel very uncomfortable having. So the importance of having a really trusted realtor, friend, mortgage broker that can educate your parents about what that would look like and how it could benefit them is going to be sometimes life changing for a lot of people. So if you're thinking, well, maybe they would, maybe they won't, it doesn't hurt to ask. It's also another way that a lot of first time buyers are finding their ways of getting into the marketplace.
Yep,
Yeah.
yep, very true. Let's go into the next slide.
Oh, sorry. I was going to say we just missed out on the closing costs section here.
No, oh, my apologies. The closing
Yeah,
costs, we
you're
also
good.
spoke about it as well, which was the rebates that you're getting as well as a first-time home buyer, that you're able to actually, you're eligible that through your lawyer as well, that
Yeah.
they're depending on what region you get that rebate, which is massive.
I think the only other one, I guess, well, it's on this slide. Never mind. Go for it.
Yes, it's on this one. The government programs for home buyers. And now I'm going to go in detail of what these programs are. An example, like I spoke about before, first home savings account, tax deductible contributions, tax-free growth. And it's also tax-free withdrawals to qualify you as a first-time home buyer. This is actually a really, really neat account that they opened up for a lot of people. And I like it actually the most out of all of them because you're able to take out these funds without having to recontribute it back into the program that you place it in, which is very nice. As well, you can grow these funds tax free. So if you have it in investments or stocks or mutual funds, GICs, all that interest that you generated or all that growth that you generate is tax free, ready to be used for your house. So it's very neat, that one. Then we have the RSP, the home buyers plan, which almost everybody knows about, but I'm going to go into it as well. And they had actually they upgraded it now that you're able to withdraw up to $60,000 per person. So every year they have been increasing a little bit more and more. Now it's actually 60,000 per person, which means that if you've been saving up for the RSPs, so maybe you've been using that to lower your taxes or anything else that you've been using it for, you're actually able to withdraw those funds for your property when you're purchasing it. The only rule is you have to repay it back within 15 years. So if I give you an example in numbers, if you take out 15,000 in a 15-year span, you had to return $1,000 back into that account. One key note that I want to say with that, from my experience working at the bank, is when you do make that contribution back into your RSP and you're going to give that slip, your tax slip back to your accountant, please emphasize that this $1,000 or whatever amount that you put into it is going back to the home buyer plan that you put it for. That's why you took it out. You have to be very specific with that. I want to speak about the first-time home buyers tax credit, which is huge as well. So the tax credit alone, let's say an example, we put it over here. If you're putting a federal non-refundable tax credit of 10,000, resulting up to $1,500 of tax return, tax reduction, which is for a lot of people, anything helps at the end of the day. Anything helps for that one. So helping offset that. Oh, I think is there a question?
Yeah, I think we have a few questions. Maybe we'll answer this one. So the question was, is a tax credit specific for new homes and not pre-existing owned properties?
Great question. So the tax credit, this is only for if you're looking at using it for the first home. Now, the HST and the GST, new home rebate as well, is also for that, but
So
that's for all
I,
buyers.
I think she was asking actually whether it was for new construction or resale,
Oh, my apologies.
if it
Well,
applies.
the first home buyers, the HST and GST new housing rebate, that one applies for new homes, completely not resale, completely new properties.
But the first-time
Okay.
buyer tax credit, that applies to both, whether you're buying a
That
brand
applies
new
to
home.
both as well.
Yeah,
That
okay.
applies to both. That one applies to both. But then we have the second one, the HST and GST, that one applies for new properties. And what's great about that one, you're actually able to get a rebate as up to a max of $50,000 credit. So that one actually just came out this
Well,
month
now
of
it's
April.
actually up to 130,000 and up to
Amazing.
$1.5 million of a purchase price. So yeah, this is a
Mhm.
big one. Everyone that's on this call probably is wondering, well, what is this GST, HST new housing rebate that's making headlines and what's the purpose of it? As Francisco mentioned, it is for brand new construction. This would be classified as a house that is already built or a condo that's been completed and there are remaining inventory, right, from the builder. So they're just sitting on these empty homes or empty units, but they're ready to be moved in immediately. So as long as it's been transferred ownership from a builder's hands to yours, you can qualify for this GST and HST new housing rebate. Now, the government of Canada, they've implemented it in hopes to stimulate the pre-construction market or new construction market because there have not been, as far as I've experienced, many of those sales happening anymore in the last 3 years since the interest rate hikes, and now with the interest rate declines. So, with that said, it's one of the ways that the government of Canada is hoping that it will stimulate that market, sell more pre-construction units, and hopefully get in front of a bigger potential problem, which is, our supply and our lack of supply in the market right now, and what could be a big problem in the next 5 years.
Yeah. Now I see that you had okay, your questions were answered as well. That's good. You had a few other ones of the RSP and also the variable. Should we jump into those right now or wait for them at the very
Um,
end, Caitlin?
yeah, we'll tackle all of them. By the end of the presentation, we may have already answered some of these questions, so we'll definitely get to that at some point. But glad we were able to get you answers, Kathy. And yes, I don't like paying taxes either. If I could avoid it entirely, I would. Unfortunately, we don't live in the Cayman Islands yet. All right, I think,
Amazing.
yeah.
Financial readiness for homeowners. I think this is a really important topic, and we can speak about it for a little bit. Whether you're a first home buyer, whether you're purchasing for a cottage or investment property, it's good to know the four pillars of what's going to help you when it comes to getting ready for this for any property you're looking for. So number one, to understanding the down payment that you're able to put in a specific property. So as an example, if you're looking for a property you're looking to live in, whether you're a first-time home buyer, you can put the minimum 5% down, or you're looking to put the 20% down. That will depend on how much you're looking for, you're able to put down, and also the budgeting that you're able to have onto the property. Credit score is a huge factor when you're looking to purchase property. Believe it or not, depending on how strong your credit score is, helps you with a better rate. Now, what helps with the credit scores keeping it strong? Paying your bills on time, keeping your utilization low. So the rule of thumb for utilization of your credit limits, usually paying using 30% of the total limit, helps, believe it or not, your credit increase up, continue to rise. And also just making regular payments that will help your credit score. Credit score is a key factor that we're going to be speaking about throughout this whole masterclass because it does dictate where you're going to be landing and what type of rate you're able to get as well. Um, Budgeting. Now, this is something that my team and we do, and we actually love doing it because it really helps clients understand what they're getting themselves into even before putting an offer. So, what I always like to do as a practice is, if you like a certain property, um, look into the numbers of how much would it cost you monthly. Add the principal and interest plus the property tax plus utilities and heating costs or anything else, and factor that into your monthly budget. Is that something that is affordable for you? Maybe you want to put a purchase price offer that's more aligned to your goals and how much you're able to budget for. So this is a very key important one. Then
Yeah.
we have last lender types.
Yeah, sorry. I
The
was just going
lender,
to say budgeting is my favorite topic, I think, with all of our clients.
yeah.
A big thing about that too, and I think I stress it a lot. I tell people that I work with all the time that you do not live in the purchase price, you live in your monthly payments, and I cannot stress that enough. Although you may get approved for $1 million mortgage or a $500,000 mortgage, does not matter. And you're looking at, homes or condos in and around that range, and the bank says you can get the mortgage based on the stress test, which is 2% higher than what you're getting qualified for as of that day. Knowing what you can afford to live with every single month. I think I saw one of the questions actually in the chat, which someone mentioned, the concern around, I don't know what it would be if the interest rates ever move. Like, that would really stress me out, which is a fair argument. I think a lot of people cannot manage the unknown or the uncertainty that their payments could fluctuate and in the incline from where it is. So budgeting, most importantly, aside from just writing the numbers down, like the monthly mortgage payment, property taxes, insurance, and maintenance fees, if that applies, if it's a condo, and any miscellaneous like rental equipment on a property. HVAC is a big one. Hot water tanks, very commonly rented. By adding all those together and then deducting not just what the bank is saying, what you can qualify for the purchase price, but what do you enjoy doing every single year, right? Maybe you enjoy taking a vacation once or twice a year. The bank doesn't know that. Maybe you have a
Mhm,
Netflix account. Maybe you have a monthly gym subscription. It's not as if these are unsecured debts that the bank is going to consider as a factor for your mortgage application. This is something that you have to sit down with yourself or with a spouse, partner, friend, or parent, whoever is going on the mortgage with you, to really understand, is this something I can live with comfortably? Or, in other words, am I going house poor? Am I paying this amount every month, but now I'm sacrificing my lifestyle? I'm
mhm,
uncomfortable. Don't get me wrong, people make sacrifices within reason, but the essence of buying real estate is not to feel like you're giving up a lot of things that you enjoy in order to have a roof over your head. We know it's a
mhm.
non-discretionary expense. Everyone needs a place to live, but you need to go about it very smartly and have great professionals by your side to kind of bring you back to earth sometimes. That's all I wanted to say.
Yeah, it's perfect. It's perfect. It makes a lot of sense, and it's going to help a lot of people budgeting and making sure that they can utilize it. The last pillar I want to speak about, the lender types, and this is very important as well. The different type of lenders are out there, whether you're looking at a traditional bank, whether you're looking at credit unions, the B banks that we're going to be diving into, and also private institutions or private lenders as well. They all have a different range of interest rates, also different styles of making their payments, also different amortizations. So that also keys back into budgeting and understanding with my financial picture, portfolio, and with this lender that I'm aligned to, does my budgeting work? Does it align with my lifestyle? So that's a really important tip that we look into, and Kayla and I, we help you navigate that and make sure that this is the right this is the right approach. It's not just about having the right house, but it's also having the right mortgage product, making sure that that will help you sustain and maintain that property as you're going along. Because we're not looking to just keep you in the property, but also make sure that you have a good life after that as well.
Awesome.
So that's for that one.
We have another poll actually I want to put up here. Just we'll give everyone a minute. If you could put your answers in. So
Mm.
I'd love to know, would you choose a lower payment per month or a faster payoff of your
What would
mortgage?
you do?
I would do a faster payoff.
Me too.
But I guess it's all subjective. I shouldn't say never. Not always. I think it depends on the investment.
Yep, for sure. What
Sounds
type
like
of
the
property you're
entire crowd
purchasing?
has spoken. Everyone wants to do a payoff quickly.
Yeah,
All right.
amazing. So this is where I speak about new mortgages, or you have an existing mortgage, and what are some tips that can help? We have a few tips that we want to lay out. Fixed or variable, we spoke about this in the beginning, but I'll touch point very highly again because it really, I want to drive it home. It all depends. My number one tip, either taking a fixed or variable, as I always tell clients, like we have to make sure it matches with your personality and with your lifestyle. Are you comfortable taking the swings in the market? Are you comfortable staying up to date with the market and making sure that, you know what, this is the right choice for me? Or are you somebody that you just want to have that peace of mind? You want to make your steady payments every single month. Really, that's what I always reflect on. Whenever I'm speaking to someone on a discovery call, we make sure we understand what rates are you looking for. Maybe somebody else got a fantastic rate at a variable and you want to take advantage of the same rate, but it also comes down to what are you most comfortable with? The power of pre-approvals. This is a huge one because sometimes you may find that people like myself, I'll be shopping around houses, seeing how this one's so beautiful, that one I love this, I think this value's excellent, and I can afford the purchase price, but you don't actually um, know until you do a pre-approval. And that's why the power of pre-approval really helps you understand where you can fit yourself into this market and what type of properties you can be looking at. It also helps you be able to have a more narrow pick and more focused outlook on where you're looking to purchase and what type of property you're looking to purchase. So it really helps and it goes a long way. And it also allows us to be able to navigate you better on what's the budgeting is going to be for, what should your max purchase price be, and what interest rates can be collab with this one as well. I know as well, Caitlin, like yourself, you always encourage the pre-approvals, and I think we speak about that together multiple times because it really helps you understand from your side too.
Yeah, I mean, I definitely think there's different levels to a pre-approval. Definitely, I think the one that many people know, which is send in your application and then you'll get an answer from the
Hmm.
bank, and that's a pre-approval. You can start the conversation. I think it doesn't hurt if you're just curious what that might translate to. Doesn't mean you have to pull your credit, does not mean you have to go down
Yeah.
the rabbit hole of pulling documents, but I think having the conversation and preparing yourself is half the battle to a pre-approval. And of course, if you feel like you're up for it, you want to plan, 4 months ahead. Pre-approvals, they're there for sometimes 120 days, which you use it if you use it, you don't if you don't.
Yep. And you're absolutely right. You can do pre-approvals even without pulling the credit, just so you can have an idea of what you're getting yourself into. You don't necessarily have, if you're looking to purchase in a month or 9 months from now or a year, you don't necessarily have to have your credit pulled. We can still have a general idea of what you can get yourself into. Usually, whenever we do pre-approvals, we're looking at, depending on your time frame, that's when we're looking to either, are we going to check the credit 100% to make sure that we have the most accurate answer, or you know what, we want to have a general idea of where we fit in this market. Maybe we're not ready right away, but we want to know what our numbers would be. One next tip, rental income and equity strategy. So I actually really like this one because it helps us in the mortgage application not get not get creative, but utilize what we have in front of us. As an example, if you're looking to purchase a second property, or you're looking to purchase your first property and you notice that that property may have a second dwelling or a second unit in there, we can use that to help us qualify for a much higher purchase price. Because now in the bank size, if we put our banker hat on the bank size, you are now noticing that there's, as an example, let's say Francisco's looking to purchase property A, but property A has a kitchen in the basement as well. So technically it's two units. It seems on paper that there's two incomes supporting the mortgage or supporting this property. This allows me when I'm submitting my documents to the bank, have a potential higher approval amount because now there's more income that this one property can generate for me. Um, Same thing if you're looking to buy your second property. Example, if you're not looking to sell your first home right away, but you're looking to buy another one, you can leverage and utilize your existing property, allow it to generate some rental income for you. So now when you're entering your new property, you have much more ammunition, much more income that you can show to help you purchase. So you're leveraging not just your own income, but also the income of your property. So it starts multiplying and helping you. The equity strategy is also really good because sometimes, let's say you may not have the funds available in cash to help you put a down payment in another property or help you purchase this beautiful home that you're looking for. This is where the equity of your existing home may be able to help you, depending on the value and depending on how much what your mortgage amount is. You may have some equity that you're actually able to tap into and utilize to leverage for your next property as a down payment, or you're either leveraging it to support you, maybe fixing up your home so it can help you for a better market rent that you can receive, or just if you're looking to sell that home eventually. Um, I want to speak about you optimizing your credit and debt impact. We spoke about it the last slide, but I want to speak about it again. Having a good credit record or having a good credit score really goes a long way, and building those good habits. So, like I mentioned, the 30% rule. So if your limit is 1,000, try to use 30% of that limit. And once you hit that 30%, try to pay it off. It's either that or try to pay it off every 2 weeks on a fixed date. Believe me, you will find that your credit will raise and will go up higher than normal, than if you're just paying it once a month. So that's a really good tip. Um, the debt impact, like Caitlin was saying, maybe the bank doesn't see it, but there's also other stuff that the bank does see. So, like if you're leasing a car or if you're financing a vehicle, if you have a loan that you have fixed payments on, all of this is factored in onto your application. So sometimes we usually take a step back when we're helping individuals and we look at their whole holistic picture and understand before purchasing a property, does it make sense to save more of a down payment or to pay off your debts quicker? My personal opinion is I usually look at paying off the debts quicker because that has a heavier impact on your mortgage application than saving up a larger down payment.
I'm looking forward to getting into all of it. There's so many different, I guess, ways to utilize your mortgage to work for you. And I think for a lot of people on this call, they want to know, well, you may have people that you're aware of that are financially free or at the point where that they own multiple properties, and some are curious as to how that's even feasible. So we'll get into that, but over the next few slides.
Mhm. Choosing your lender, like we spoke about it before. You found the perfect property. Okay, you have a great rate as well, but we want to make sure, well, not just a great rate, but also you want to make sure that it's the lender aligns or the bank aligns with what you're looking to achieve. You want to make sure that you have a good product that supports you, that's able to uh, give you the utilization that you're looking for when you actually live in that property? Does it allow you to accelerate payments if you're looking for that? Does it allow you to have lump sum payments? So lump sum means if you're looking to do some deposits while you have the mortgage. Does it allow you to tap into the equity of your home? As an example, is it a home equity line of credit, or is it or as Scotia calls it, a step mortgage, like a home line of credit that allows you to um, take out equity when you need to? So choosing the lender is very important as well.
Hmm.
Amortization. Now, this is actually a really important one that I look at. Um, Amortization, it's not about always trying to squeeze the lifespan of your mortgage as low as possible, because that's what amortization really is. It's the lifespan of your mortgage. You're not looking to, most of the time, my advice is to make sure that if you can comfortably take a 30 year, because if you can increase your payments to 25 years afterwards by increasing your payments, by doubling up your payments, and always have that default of 30 years, that will work wonders for you. Because as an example, maybe right now in your partner, you both are generating a very strong income, which is fantastic. And you feel like you can pay off your mortgage as quickly as possible. I would always recommend to start with a 30-year amortization and increase your payments to potentially lower the amortization, whether you can increase it to a 25-year amortization or a 20-year. What does this do? This helps you pay off your mortgage quicker. But let's say if something happens to you, you or your spouse, and you're not able to continue paying that aggressive payments, you can always go back to your default payments, which will typically be your 30 amortization. So that is key, and this is why this is a really good tip. Always start with the largest amortization, which is 30 years. And if you're comfortable paying higher, make that payments afterwards, but you can always go backwards to 30. Because imagine if you started at 25, that is your default. You will never be able to go backwards. So always start with 30 years. And if you can increase it, great.
Yeah, that's a great nugget. I don't think a lot of people consider it that way. So thanks for that.
Yeah. It's very good. And also monthly carrying costs, like we spoke about before. It's not just the principal and interest that comes into your monthly carrying costs. There's also property tax, utilization, heating costs. Maybe there's sometimes condo fees on top of that as well. Um, we want to factor all that into your mortgage and make sure that you're comfortable. Again, maybe this is your first property. You have to make sure you're budgeting, or maybe this is a second property for a rental property as well, that you want to make sure that your numbers align. That if you're getting X amount of rent, that your monthly carrying cost either doesn't exceed that too much, or if it does, it's still manageable for you. And I think that's a big deal that Caitlin and I look at a lot. That we're making sure that even if it's a rental property, making sure that the monthly carrying cost is doable for the clients.
Yeah, these are fixed expenses. It's not yeah, I want to pay it. No, I don't want to pay it. These are things that are as part of the purchase. So it needs to be treated as something that's, it's not, you can't move it.
Yes, absolutely. Let's jump into the next one. Okay, my absolute favorite slide. Purchase success stories. Why is this my favorite? Because just the joy that we got, and these are clients that Kay and I both helped and supported from the beginning to end, and it was absolutely amazing. So, I'm going to speak about the first one, which was a bankruptcy approved purchase, which is huge. We've had this example was we had a lovely couple that were looking to purchase their first property together. Um, what happened was that one of the individuals actually had a bankruptcy that was declared 6 years ago. So a quick note: if you do have bankruptcy, it stays on your credit for 7 years, and the banks see it for 7 years. They typically the policy is that they want it to, if you're applying for a mortgage, they want it to be past the 7 year term. This individual had 6 years, so they still had 1 year left. Okay. Um, Not only that, it did impact his credit at that time. So how were we able to get this approval at an A bank, specifically at BMO? Well, Caitlin and I, we both worked together to make sure that we showed strong assets. We didn't just allow the numbers to speak for themselves. We also spoke about the individual himself. What assets do they have? What have they done since they had that bankruptcy to now to build their credit up to this point? And their credibility. Also, we spoke about the partner. The partner has great asset. He's never had any bankruptcy, and he always has low utilization. They both had great jobs as well that we spoke highly of, and that they can continue generating strong income. So sometimes the reason why we get these approvals is not just because we put paper with pen, but it's also the story that we tell that we help them get these homes, and that's why it's one of my favorite parts of my career. So that was a huge one. Um, did you want to speak about that one, or did you want me to go
No,
on
I
to the
think
next one?
I think you
And
spoke exactly. You said it all. I guess the
perfect.
other one, which is unique careers and co-signers, I think, yeah, I mean, there's a lot of people probably on this call that are self-employed, or in a position where that it's not your typical straightforward, 9 to 5 and employed by a single employer. It could be, half employee slash getting commission, right? Those are also very unique cases. I guess, Francisco, you're going to speak on who this exactly was. I know there's been a lot of people we've helped that have fit the bill in either one of these four categories. So,
Yeah, this one was really neat as well because maybe a lot of people have this idea that just because you may not have the typical job that the bank's looking for, a 9 to 5, you have a salary, maybe you might get some bonuses, that you don't fit with the A banks. You have to go to privates, you have to go to credit unions or V banks. Not true all the time. We are still able to make sense of the file and make sure that we can help those homeowners purchase properties. So specifically with this case, the two individuals, they had unique jobs that they may have not unique because one of them was self-employed. They're just starting off their business and they are building great traction, but maybe standing just alone, they may have not been able to purchase that property. Then they had the other individual that he also had a great job, unique income because he wasn't getting paid all the time. It was more of a casual income as well, but we were able to speak on the history and the whole overall career industry, the history of the career that he had in that industry as well. And we were able to bring in a co-signer. So sometimes a co-signer helps and they actually impact the application in a much better way because now we have a third person that has strong income, strong credit, and they can balance out the whole file. So that was very neat for this one that we were able to get it on the A side as well.
I was going to ask Francisco just on the topic of co-signers versus guarantor. I want to know just from your perspective where one impact lies for the co-signer and a guarantor, because I think a lot of people will wonder how, as if they chose to be a co-signer, if they chose to be a guarantor on someone else's application for a mortgage. I know there's liability, of course, there, but how does that impact maybe their affordability, right? Like, let's say the
Yeah,
co-signer, the guarantor wanted to go and buy something, is this mortgage now tied to them in a sense, right?
that's a great question. And it's
Or
so
maybe, for instance, a kid who is, employed, they have strong income and they just need to be added to the mortgage for the purposes of the approval, but they don't want to forego their first-time home buyers incentives, right? Because they've not
mm,
actually went and bought their own first home,
mhm.
right? How does that work?
It's all good questions. So first of all, let's unravel that. A guarantor means you're not necessarily on title of the property, but you're on the mortgage. Okay, so who can be a guarantor? Normally, it's parents or direct siblings. Okay, it can't or spouse as well. It cannot be anyone outside. It can't be your friend. It can't be a cousin. Unfortunately, it has to be someone that's directly linked to you and in your personal life.
Or your immediate
Um,
family?
your immediate family. Exactly. That's the right word. Guarantor. Then if you have a co-applicant is actually not just on the mortgage, but also on title. So they're also on the legal side of it when you see the legal registration, they'll see Francisco, let's say Caitlin, and then they'll have the co-signer as well, that they're on title as well. What are the pros and cons of both? Well, right off the bat, they're whether you're a guarantor or co-applicant, this will still carry on in your name. So if you're looking to take on another mortgage or another property, this is still a factor into your application. So even as a guarantor, you're jumping onto, let's say, Caitlin would be coming on to my application as a guarantor, her assets and liabilities, her personal or financial photo profile would still show on my application. Whether if she's looking, and then afterwards, if she's looking to purchase a car or anything else, our mortgage will still show on her profile. So
As
whether
debt.
it's guarantor and debt, so
Okay.
whether it's guarantor or co-op signer, Caitlin, it's still going to show on your credits overall
I
as a
guess
debt.
it's from the sounds of it, it seems like being a guarantor, you're benefiting from the fact that you technically, if you're not on title, you've not owned a home, or if there's never been a home in your name, correct?
Exactly.
So you are
Exactly.
still considered a first-time home buyer. Is that right?
Yes. Yes,
Okay.
because that still helps you in that sense, because that would be the benefit as a guarantor. That's the major benefit of it, that you're not technically shown on title. So you can still bypass that. Absolutely.
Yeah, and qualify as a first-time home buyer. Okay.
And qualify.
Awesome.
Now, this one, the third one was also a very, very neat purchase that we had, which was minimum income senior purchase. So again, looking back at my history when I worked at the bank, typically the A banks, they look at qualifying you based on income qualifying. They don't look at anything else. They don't really look into the story too deep. They look at how much income you make, how much down payment. That's the mortgage that we can get you, or the purchase price. There are other credit unions, other banks out there that help qualify you, even if you're not showing too much income. Specifically for this case, we were able to get this individual a mortgage at a bank called Equitable Bank. And they have a very nice mortgage product, which is called reverse mortgages. Now, reverse mortgages may have a certain feeling towards them. Maybe some people don't feel too positive towards it. Maybe other people just don't know what it is. If I can speak very high level of it, a reverse mortgage is for individuals that are of the age of older, 55 or older. They qualify you based on your age. Income is a factor. They qualify you on your credit and the percentage of what you're looking for on the property. So the younger you are, the less of a loan to value you're getting. Loan to value is like mortgage to the value of the property. And um as you're getting older of age as well, they allow you to get access to a much larger mortgage. You're able to get up to a loan or a mortgage amount of value of 55% of the property. So for a lot of people, that helps them out, because maybe at a traditional bank, they wouldn't have been able to qualify based because they don't have the income to qualify for a 50% loan of the property value. But a reverse mortgage, they look at that and they actually flip that all that underwriting on its head, and they qualify you in the age and they help you purchase that. Specifically for this case, I put the example below of what the numbers were. This individual purchased a property and they got a mortgage of 405,000 with $900. Interest rates, this is one thing about the reverse mortgage. Interest rates are slightly higher at a 6.88%. Now, before going to the payment, which is interest payment, why are the rates higher than a traditional bank? Because they qualify you differently. Traditional banks, they have the backing of the government and they qualify you based on your income, based on your down payments as well. When you're looking at alternative ways of qualifying you, the banks are taking on a different approach to it. So they have slightly higher interest rates. That's why overall everybody would, if they can, they always try to stick to the A banks. Um, the interest rate is higher to reverse. However, they do have many other benefits. One of the benefits is that the payments are just interest only. So even with the rate being higher, you're still getting a total monthly payment of $2,294. Not only that, at a reverse mortgage, you can defer the payments. So you can actually, let's say, an example, your mortgage is 100,000, or we'll use this example, 400,000, and your payments are, let's say, I round it up to 2,300. You're able to defer those payments and actually put it and allow it to accumulate on top of your mortgage. So depending on your lifestyle, depending on if you're not actually able to afford those payments, you are able to defer it and continue living your life peacefully, which is actually a very good tool to have. Maybe some people don't feel comfortable deferring it. So you have the option of paying the interest. Maybe some people can't make the payments at that certain month, then they defer those payments. So this
I
was
was
a really, really
Yeah, I was
unique
gonna say this
purchase.
one's a really good one because I find a lot of people, especially as they are getting older and in retirement years, are thinking of making moves and are not working anymore, understandably and rightfully so, and are not sure how best to navigate a upsize move, where
Yeah.
that they need a larger mortgage, right? Or a small mortgage in this case. And they may commonly smaller mortgages for reverse mortgages because they have maybe a set amount of cash. They don't want to touch their other investments, so they rather just keep them while they are, incurring more profits from them and get a small mortgage. But from a lender conventional mortgage perspective, where they would just go to the bank and be treated like any other buyer in this market, they go through very stringent requirements and documents that they need to provide in order to qualify. Where in most cases, because of their low income relative to the carrying costs, even though they may be small, it's generally a lot harder. So the reverse mortgage is an easier option. Payments are comparable to what it would be, Francisco, right, for a lender
Yes.
and a conventional mortgage. And in this case, for this particular client, they were able to also have a portion of this bigger home be rented. So it actually offset the entire cost associated with the interest payment. So they're still more than comfortable and probably paying around the same that they were for, a much smaller house that was much lesser valued.
Yeah. Yeah.
Yeah.
And we're going to jump into those payments as well, showing the graduation program as well, even if there was something like that.
Mhm.
And I want to speak about the fourth success story that we had, which was very, very cool. Returning to Canada plus overseas self-employed. So again, it's all about telling the story and understanding where to fit this mortgage for the client. This individual was actually returning to Canada from the UK. He had a very successful self-employed business in the UK. At first, you may be looking at, okay, can we translate that income to Canada? Fortunately, in Canada right now, with the policies, they don't necessarily look at foreign income that is self-employed. If it's from a Fortune 500 company, then they may consider it. But when you're self-employed overseas, they don't look at that income unless you are claiming it in Canada. So we had an individual that's coming back to Canada. They haven't been here for a while and they're self-employed over there. What were we able to do? We actually set him up in a graduation program. So we set him up with one of our lenders. In this specific case, it was more like a C bank, like a private institution. We were able to get him friendly rates as well, and able to get him into the property that he was looking to purchase. From there, we're now starting him in the graduation program. So what does that mean? We're going to speak more about it in the next slides, but very high level is that we never look at keeping a client in one specific tier. We always want to graduate them eventually to the A side. Whether you started at the B, whether you started at the C, we always eventually want to bring you back to the A side, which is the banks, TD, Scotia, RBC. So for this specific individual, we've got him into the property that he loves, and now we're looking to get him back to the B side or back to the A side by showing increased income, by showing credits in Canada that he's had established and paying off his taxes, and by showing that he's been able to pay his payments consistently. So we gradually bring him up to the A side. But this was a huge success story because at the time the client was feeling very down, or they felt that maybe they would have to rent. Not the case. We were able to still buy him, get him a beautiful home.
I was going to say it's important to preface when we say returning to Canada, we don't mean foreign buyers or non-residents in a sense.
No.
Um,
Yeah.
Not entirely, at least. There is still a foreign buyers ban, so this is not to be
Mhm.
confused with that. We are not assisting people that are, foreign buyers and getting them into the marketplace. That wouldn't be possible, and if it were, then I'm sure everyone would be jumping at
Mhm.
the opportunity to enter our market
Yes.
state that it's in.
Yes.
So yeah, no, I think this was probably one of the more unique, very unique situations for a client that we've had in some time. But it was, I mean, good to know that even as you mentioned, going alternative lending options like private lending, a lot of people they would go absolutely not. That's 20% of an interest rate. I'm going to be paying out my ears or my nose for this house. I'm going to be completely broke by the end of it. Not true. And I think that's why it's helpful to have, trusted mortgage broker. You can always pick their brain, like Francisco, and understanding what interest rates are being offered from an A lender, B lender, C lender, or private lending options if it comes down to it.
Exactly. Exactly. So we were very happy we were able to find it. And again, it's all about telling the story.
Yeah. Just so that the audience right now isn't falling asleep, we're just going to put another poll on the screen um, quickly here. So, I guess which one of these options would you say best describes your current situation? If you guys want to click the boxes, go for it. All right. So, quite a few people. I mean, we've had a few, well, first-time home buyers, investor. Nice. Okay. Francisco?
Perfect. So let's go into it right now of what happens now. You bought your property. Amazing. Congratulations. Or you're already a homeowner. What is the next steps? And this is what the whole masterclass was about, life after purchase. Understanding ownership and what cost comes with this. So it's not like we mentioned at the beginning, it's one thing to qualify, but it's also maintaining that lifestyle. Um, Now you're taking on, which for a lot of people is their biggest purchase of their life, their biggest uh, asset or the biggest debt in some cases as well. Making sure you can budget the property tax, home insurance, utility, um, and ongoing maintenance. A reserve of 1 to 2% of your home value annually is actually a very smart cost. So what do I mean by that? Making sure that you're able to actually put aside on top of that those funds that you're paying every single month. Not just being able to um, paying your monthly cost. Does that make sure that you're above water? It's also making sure that you're able to save, having that lifestyle as well. So one rule of thumb that we have as well is, and this is could be outside of mortgage tip, is whenever you get paid, try to put 10% funds on the side that, and then after pay your bills or whatever else, you're going to see that your lifestyle will align with everything you're doing, and also with being able to still be comfortable making your payments. That's a really key important.
Yeah.
Building your equity as you're paying down your mortgage, you're actually building this equity that eventually you'll be able to tap into. So when it comes to refinancing or renewal, which we'll be speaking about, um, that is when you're able to tap in and use the equity that you built and you worked so hard for in those walls and those four walls that you have in that property. From there, you're able to renovate your property, maybe consolidate some debts, maybe use that for another property as well, or build wealth for long-term generation. Because just because you may not see it, there is wealth in your property and there is wealth in the equity that you're building. And we're speaking about renewals and refinance opportunities. Because once you're done your mortgage one time, that doesn't mean that you may not have to do your mortgage again. You will have to go back in the table of renewing or refinancing, negotiating with your bank, trying to get better rates again. As an example, let's say if you took a 3-year fix, when those 3 years are up, you're back with your bank, seeing are we going to negotiate for the same type of 3 year, or are we going to look at maybe a variable, maybe a longer term rate, or maybe a shorter term rate? And that's what we're going to get into on the next one.
Yeah, and I was going to say, so from a reserve fund perspective, 1 to 2% of the home's value annually. Of course, most people would love to save that kind of money if they have. I think it's important to note, just even before you've actually bought the home, chances are you've done a home inspection, or I hope to God,
Mhm.
the realtor you're working with, if it's me, you would have done a home inspection for sure. But you would have basically like a homeowner's checklist ready to go. You know what to expect is likely to going to require maintenance. The furnace may be of a certain age, close to the end of its life expectancy. You may have, insulation you may need to top up in the attic, right? For the purposes of having a more efficient home. These things are ways that you can buffer money aside, even right before you've purchased and closed. So even if this is like your period of time where it's, I mean, in the States they call it escrow, but here it's just your pending closing. Instead of putting all your money towards the asset, yes, down payment's super important, but also factor in that reserve fund that Francisco spoke about so that you're keeping maybe 2, 3, 4 months worth of fixed expenses, your carrying costs, and a little bit more than in order to cover those potential unknowns and to also get ahead of things that can come up as it relates to the maintenance of every home. But no, that's a
Yes.
great point, Francisco.
Yes, it's very important. And it leads on to the next one that we'll be speaking about,
Yeah,
which
and
is
wait,
steps
we
prior
have
to
one
renewal.
more poll just before we get into it because I think this is super important. I'll wait for Dave to get it on the screen. So, what do you think is the most underestimated cost of owning a home? I'd
Ooh,
be curious. There's quite a few options.
this is a good one.
Yeah. So, property taxes, maintenance and repairs, utilities, or the interest paid over time on your asset. The most underestimated, guys. We'll give everybody just a few more seconds. All right, Francisco, do you want to give everybody the answer?
I want to say it's utilities.
Yeah,
That's the one. Nice.
yeah. Utilities. I mean, a lot of people, if they've never rented a home before, they don't actually know the cost of utilities. So they're just taking a kind of guess at it or just not even factoring it in entirely. And they
Right.
get these bills and they're like, wait, what was this? No one told me about it. But yeah, utilities is a big one.
Yeah, because it depends on the months. It depends on also the season that you're in as well. Sometimes the utilities can actually be more expensive in that season than it can be in other times. So that is something that you may not foresee or you wouldn't really estimate of how much it could be, but that's it is very true.
Yeah.
Okay, let's jump into steps prior to renewal. Before, I always like to say, before you're going to sign or renew with the current bank that you're in, I like to always try to take a step back and reflect on what makes sense for you specifically in this mortgage. So in this case, it means starting early. Try to start talking, not just with your bank, but maybe if I have the pleasure to working with you as well, 120 days earlier, I would love to start the conversation. Why is that? We can take advantage of the market much earlier in the time frame than we would be if we're very tight to the closing. Okay. Remember, you want to be able to find the best rate and shop it around with all institutions, not just with your bank. Giving yourself that time frame really lets you sit back, lay out all the rates that you're given, and pick which one's the best one with the best product for you.
Well, Francisco,
Then
maybe
we
you
have,
can speak about the fact that in the last, I'd say 60 days, we've seen fixed rates adjust, upwards. And this has impacted people, right? They were starting their mortgage approval conversation with you or renewal conversation. And you were like, nope, the rates are going to change tomorrow. Like everybody get your stuff to me now. It's a very stressful experience that, no one ever wants to go through. So if you can yeah, start the conversation as early as possible. I mean, I'm sure you know better than I do, but I'm sure my bank was reaching out to me 90 days or more before my renewal was coming up to be like, knock, knock, get ready. Here's the interest rate I have to offer you. Click to accept. Like they were pushing out the emails, the
yeah,
calls, um, and rightfully so because they want your business. But don't fall into
yeah.
that trap.
No, it's true. It's you need to understand what is out there and what makes sense for you. And another neat thing that we would want to speak about is rate holds.
Yeah.
Starting your application early actually allows you to put that a hold on that mortgage that you got until you make the decision to get back to it. So whatever happens in the market tomorrow, or maybe tomorrow we have a decrease in the market or an increase in anything that's happening, whether the oil prices are going up, whether groceries are going up, whether inflation is affecting us, you still had that rate hold from previously, which is amazing. As an example, I've actually started a file that there are mortgages closing in May, actually, but we started it late February or even mid-February. Why was that? Because I wanted to take advantage of that market now. I do not have a crystal ball. We don't know what's going to happen tomorrow, but it's always good to prepare ahead of time and take advantage of that. So that was a great thing. Reflecting on four pillars. I know we said you have four pillars for the financial readiness, but there's also four pillars for the renewal, which is cash flow. Because actually, if I take a step back, before you even look at the four pillars, I want to say was, like Caitlin said, the banks just want you to sign and move on. They want to lock you in and move on. But maybe that doesn't fit your picture. Why? Because you want to look at cash flow. Can you handle the higher payments at that time? A lot of people are coming up for renewal and the interest rates are much higher now than what they were locked in before. Are you able to make those payments right now? If you are, perfect. But also still explore what other rates are out there because most likely another bank is actually potentially able to get you a much better rate than your home bank is. Cash out. Do you need to consolidate some debts? Do you need to access some of your equity? Do you need to provide a down payment to a family? Do you need to maybe renovate on your property? This is something that you're able to do when you refinance, not technically renew, because in the renewal, you're just continuing the cycle that you've already been in. So you're just signing and you're not able to touch, tap into that equity. Then we have,
Maybe sorry, I was going to say just on the point of consolidation of debts, a big thing a lot of people do, which I find they're happy about, is depending on how much equity is in your home. Francisco, you probably have a lot of these conversations. People have outstanding debts owed, whether it be on a car payment that they have or a loan, they want to pay it off. And they feel that, well, if I borrow against my current home equity and basically lump it into my mortgage, what I'm paying every single month doesn't nearly compare to what I'm paying on just financing the vehicle for the next 8 years, which is actually massive cost savings depending on the purchase price of that car and the interest rate, because interest rates for vehicles are also higher than where
yeah,
mortgage interest rates are. I've had people that have just renewed and or refinanced, I guess, on their renewal dates, and they were able to reduce their payments by, $800 every month, which is big, right?
that's huge. The cost saving is significant. And when you look at that, what we like to do for our clients as well, it's that we show comparables. So look, if you just renewed plus having your debts outstanding compared to if you refinance and put that debt into your mortgage, you're paying an overall lower interest because maybe your credit cards have a interest rate of 21.99. Maybe you have a car loan that's at a much higher interest rate. But if you consolidate that with your mortgage, get a lower payment and overall less monthly costs, you're actually able to potentially, in some cases, if there's a huge savings of $800 that you're mentioning, maybe you can put $400 increase of your payment, and that tackles your principal much quicker,
Yeah.
which is a really, really, really good product to use. Um, Property. This is a big one as well. Maybe some people just sign and they don't realize what's going on with their sign because they're just continuing their contract. But you have to step back and look at, do I want to continue living in this property? Or do I see myself in the near future selling? That depend if that answer is if it's yes to any of those, the term or the type of mortgage that you're looking to take should reflect your decision for the next coming years. Because if you are looking to sell in the near future, maybe you're not going to look at taking a 5 year fix because you know you're probably going to be selling within 2 or 3 years. Maybe you want to take a fix, a shorter fix like a 3 year. Maybe you want to take a variable that the penalty is much lower to actually break their contract if you have to. So always reflecting, is this my forever home or is this a home that potentially I want to be able to sell in the future? Or look at to renovate, which goes back to cash out. The last one, and they all jumble into each other, is what product do you have? When you first got your mortgage, was it just a standalone mortgage that you're not able to take out any equity? If you want to switch the type of product, maybe have a product that reflects in your for your lifestyle. So can it be a line of credit that you're able to access that equity that you built? Again, very hard work that you put into paying down your mortgage, and you can utilize that equity for future renovations, future down payments, or anything else you're looking at. Making sure that that product reflects the type of mortgage, reflects your lifestyle is very important. I know I've said that many times, but it's very, very important. I have it over here. Talk to your mortgage broker. The reason why I say that is because as a mortgage specialist or a mortgage broker, we're able to not just speak to one bank, we will speak to all banks at the same time. Only, and the best benefit is we only pull the credit once during that mortgage application. Instead of you walking into every single bank and you have every single bank pulling your credit, we just do it one time and we help you explore. Maybe TD has the best rate right now, but Scotia has a great product that reflects your lifestyle much better. So that is very, very important to look at. Re Graduation plan, huge topic as well. And we spoke about that before. Let's say you were at a B bank. You were put into there as your first mortgage. Before signing and renewing with that bank, reflect to yourself, am I able to now actually leave and graduate, get to an A bank? That's what I do with my clients sometimes. We reflect, you were put into a B bank. Let's reflect on your financial picture right now. Is your credit better? Do you have more income that can support us? How is the equity in your property? Depending on those answers and how you answer those questions as well, we may be able to actually move you out and graduate you to a bank. Or if you're a C bank, maybe we can move you to a B bank and eventually to A or a C to A. It saves you a lot of money. And we're actually going to show in the next slide of how much savings it can be from a C to A. It's dramatic. It's dramatic how much you'll be saving. So it's really good to look at the graduation plan and never feel that just because you were put at a private bank or a B bank, that is the end all be all. There's always ways to help you move up. And it's by financial coaching, is by us helping you through that. There's a question, can we move banks while we have a mortgage going on? Yes, you can. So if your mortgage is still within its term, you are able to move your mortgage. However, there will be a penalty. So what I like to look at is, does it make sense to move it right now with the penalty occurring? So is the savings every so month, the interest saving greater than the penalty that you would be paying if you would break it? Or do you wait until maturity? Okay, so sometimes we look at waiting until maturity for that to happen. I hope that answers your question. Um, then we have the final one, which is guarantors and co-signers that we spoke about before. When you purchase your property, you might have had a parent, maybe a sibling, maybe your spouse. Now you're looking to take that individual out of the property. You're able to do that on the renewal stage or on the refinance stage. You're able to now take them out and be able to focus on just continuing with yourself. That is a huge benefit and something that you got to look at. Take a step back and reflect. Does this current path that I'm taking with my mortgage reflect everything that I'm looking to achieve?
Francisco, just on the point of guarantors and co-signers, I know you mentioned earlier in the call, co-signers are ones that are on title and on the mortgage. Can you explain if at the point of the renewal you're taking off a co-signer, do they get taken
Yes.
off the title? And do you know if that would then trigger any issues for like land transfer taxes? I know that's more of a lawyer question, but I'm sure there's ways to remove a co-signer off the mortgage as well as off title without causing that issue.
It's a
I'd be,
great question.
yeah.
It's a great question. Yes, you can. So if you are taking a co-signer off title, they when you're removing them off, they are being taken off title as well. So when it comes to if there's any land transfer taxes associated, there will be, and it depends on what the value of the property is at that time from the purchase of it as well. And
Yeah,
if you're
maybe
adding somebody else
I was going to say maybe this would be a great question just to unpack with the lawyer as well before
as
for
well.
removing them. But yeah, no, definitely great info.
Absolutely. So let's go to the next slide. And this one speaks about the graduation plan specifically. Now, let's say the example that we had the individual that was put into, and all these numbers reflect a mortgage of 500,000. Okay. And on the B bank and the A bank, we're going to be using amortization of 30 years. So let's reflect and assume that you started at a private institution for whichever reason you were put into there, and you're starting your home journey there. You see that the rates are roughly around an average of 8.99. Your monthly interest payments for this one would be $3,746 a month. Imagine now in 1 year's time, you're able to now graduate to a B bank. B bank, their average rates are 5.25. Your monthly payments on there are 21.88. So now you're seeing the dramatic drops on your payments. Lastly, this might be a mistake from my side. The On the A side, the rate is not 4.99, it's 3.99. And the monthly payments are 1663. So you're seeing from the A to C a dramatic difference of almost $2,000 of savings every single month. So the graduation plan is extremely important, and being motivated to get yourself up there is something that we love to see in the home journey process. How do you get there? Improving your overall credit. So maybe you had to go into private because you had to consolidate some debts as well. Maybe your credit wasn't there ready enough to get you on the A side or the B side. Increasing overall income. Maybe you just weren't able to show enough income to get to qualify those banks, but now you are. So we're able to slowly graduate you because you're building your career up. And reduce overall debts. Like it circles back with improved credit. Is your overall lifestyle or the debts that you have now being paid off quicker, and you're giving yourself enough time to now I'm ready to get to the A side. One thing I want to reflect is never be never be nervous of what bank you're going into. There's always a reason why you're put into that, and there's always a plan, and well, there's always a possibility for you to be taken out of there. Um, we had a question. I was never free to talk about this stuff regarding increased payments. I may have to start to ride a side hustle. Okay. Question: if you took money from an LLP, is that okay when you're trying to withdraw from RRSPs and um, for some home buyers? When you mean the LLP, do you mean like a corporation account that you're taking out funds from? Because if that's the case, lifelong learning. Yet the lifelong learning, you can't use that for the property of your purchase. That would specifically be just for educational purposes that you're able to use it. Now, the reason why you wouldn't be able to use it is because when you're taking out the funds for lifelong learning, they specifically look at what courses you might take or what school you'd be taking. They don't just like when you're taking out funds from a first-time home buyer or an RSP, they will actually make sure that you are taking out funds for that property. I mean, if I withdrew funds from school and now want to buy the property, is that okay to use it from your RSP? That's a great question. I mean, you did take it out for the school. You do have to return it. You do technically have to pay back, but maybe you didn't have to use it. So my question, that is more of a lawyer answer, but I would say technically you're not supposed to. You have to use that for educational purposes.
Awesome. Okay, so I was gonna say maybe we'll go on to the next slide.
Finally, very quickly, we'll just review the renewal pillars. Again, like I spoke about, cash flow, cash out, property and the title, which is, are you looking to remove someone? Are you looking to maybe add someone as well? And product and lender. Are we able to graduate you and move you to another institution as well? We spoke about this highly in the previous slides as well. So that's for this one.
All right. And then there is one more poll, and maybe we'll go to the next slide and bring that up. Okay, how many Canadian mortgages are set to renew in 2026? I'd love to know everyone's
Yes.
guess. I was surprised when I heard this information, by the way.
Hmm.
Wow. We're already starting high. Close. Okay. Give everyone a few seconds. So, great guesses, everyone. I think everyone was choosing 66% because that just seemed like the highest and most absurd. But no, you're really close. It was 60%, but even still, 60% of Canadian mortgages that are coming up for renewal, that's a huge amount, right?
Huge.
I mean, over 50%, even still, chances are you live with someone or you know of someone that is going through a mortgage renewal this year. It's a huge figure, and I know people will wonder, well, what does that mean for our marketplace as a result of all these mortgages coming up for renewal? Maybe Francisco, you can speak to that. What are you finding, like the type of people that you're dealing with now on the ground running and in this business day in and day out? For the mortgage renewals that are happening, are there people that are in desperate situations? Are they in, did they budget for this? Are they comfortable? Are
Um,
people renewing?
for sure, there are people come in all shapes and sizes. I think the most important part whenever it comes to the renewal is just understanding their story and what they're looking to achieve or have the outcome for it. So whenever it come, maybe one individual may have a difficult time with their current, with the rates that they're showing. So we have to do we stretch their amortization to help them be able to budget more? Maybe some people are not able to be able to just renew because they have some debts outside. So we look at consolidating their debts as well. There's many factors of how we look at the renewal process. So again, what we speak about is like, I want to just tell the story and make sure that it makes sense for your whole lifestyle. Not just get the numbers matching, not just make sure getting the best rate, but also looking at it holistically and make sure it makes sense for your lifestyle overall.
Yeah, fair enough. Well, with that said, I know we're going to open things up now to some Q&As. I know we had some really good ones going back and forth. And,
Very good
and
ones.
just,
Yeah.
Francisco, for people that are not on the call, that I asked just to see if they had any questions that they'd like addressed. I think one in
Yes.
particular that came up was, and we've already kind of touched on it, but just kind of how not to completely be filing for bankruptcy in a sense in order to afford a home, right? How to go about that. And I think during our call today, we've kind of unpacked every possible angle about it. But is there any like last minute tips or, notes that you'd like to share with our audience today?
Again, it all comes down to budgeting and understand and being as realistic and um, personal with yourself of what you're getting yourself into. Really look into, like you said, Caitlin, as well. Do you have any subscriptions or anything else that may have not been factored into the mortgage application that is still affecting you on a day-to-day basis? Do you maybe unsubscribe from those or take those um, expenses out of the picture before you jump into a property? You don't want to stretch yourself too thin. And again, this is why we emphasize before you look at purchasing a property, we run scenarios for clients. We add all the fixed payments and make sure, is this something doable for you? Or do you know what? Maybe you have to get a lower purchase price. Or is there something outside of the picture? And that's where Caitlin always speaks to them as well and make sure that, are there anything else that we could help you to reduce your monthly cost before even purchasing a property? So budgeting is number
Yeah.
one.
Great. And I guess there was another question here in the chat. I'm not sure if you answered it, but the question was, if I don't like my variable term and I want to end it, will I have to pay 3 months interest for future months,
Yes,
or
and
all at once? And
that's a great question.
maybe we can clarify if you mean end it by stating you're going from variable to fixed, or if you are completely ending your term like you've sold the property and you were on a variable interest rate mortgage. Maybe Francisco, you can answer from both angles. If you're going fixed, variable to fixed, or if you're ending your variable term because you've sold it.
Yeah, for sure. So if you are looking to switch your variable mortgage into a fixed, the technical wording is as long as it's after your first interest payment, you're able to switch to a fix at any point without a penalty. So it's without a penalty. Now, different banks have different rules. As an example, I'll give you two banks. So TD, if you're on your first year of the variable, you are able to switch to a 5-year fix, 4-year fix, or 3-year fix. Okay. If you're on your second year at TD, you're still able to switch to 5-year, 4-year, 3-year fix. You can't do lower than that. Then you have other banks like Scotia, the second example, that they match the year for year. So you're in your fifth year of the variable, you can only switch to a 5-year fix. If you're in your second year, you can only switch to a 4-year fix. Third year, three, and then two, two, and one, one.
Hmm.
So there are different banks with different policies in that, but overall, you are able to switch without a penalty. Now, if you're looking to sell your property, break the contract at any point, then there is a 3 months penalty interest that is associated with your interest rate, and that is a key point. As long as you keep that term or that contract that you have with the bank, there is no penalty.
Awesome. I hope that answers your question. I also saw here that someone in the chat mentioned that they've never bought a home. They want to see if they can get their parents to co-sign, but their parents have an existing home under their name. Whether or not they have a mortgage on it, I guess, will answer this question. But does that mean they won't be eligible as a first-time home buyer to have the co-signer?
Great question. The answer is you are still eligible. You still are available to get the first-time home buyers. As long as one of the individuals is a first-time home buyer, they are still able to get it. And they're also even able to get the rebate of the closing costs as well. So even
Okay.
if you bring on your parents, you're still able to.
Yeah, and I guess there was another question here, which I'll answer. The RSP, if it was once 25,000, now 60,000. Yes, the answer is it is 60,000 up to for first-time home buyers RSP accounts if you are using that as down payment assistance. And Francisco gave a really great slide about how the repayment works for that. I guess we'll answer one more question and then we'll let everybody kind of get on with their evening. The, where is it here? Um, is there a template for budgeting that I can get that has all kinds of lists of potential types of expenses on it as a homeowner? Yeah, definitely. I actually curated a personalized buyer's worksheet, which I give to all of my buyer clients that basically breaks down every possible expense associated with buying your home, whether it be your first home, second home, or an investment purchase that you're making. I'll share that with you off the call, but no, that's a really great question. And I think not enough people have access to those resources. And with AI and different types of, things that can be asked for from ChatGPT, you probably are going to get all different types of suggestions for budgeting, and it may not actually even apply to Canada. So that's a great question. Okay. We know everybody's here also for the Jays tickets, but
Mhm.
Francisco, if there is anything that you'd like to share with the rest of the participants here and people that you've of course invited, I would love to hear your comments.
All I want to say is just thank you so much for everybody to attend and to hear us out on our masterclass. I think it's very, very important, not just understanding purchasing your property but the life after the purchase as well, and what are good tips and habits that you can have. Thank you so much for your comments. Thank you so much for the questions you guys had. It was a privilege speaking to everybody.
Awesome. Before we wrap up today, I just want to sincerely thank each and every one of you for spending the evening with us. Your time's valuable, and we take that very seriously. Our goal tonight was simple. It was to leave you feeling more informed, confident, and empowered when it comes to one of life's biggest financial decisions. Whether you're planning a move this year, years from now, or simply want to better understand your options, I hope you're leaving with something valuable you didn't have before. A big thank you as well, Francisco, for sharing your expertise and helping make tonight so impactful. Please remember, if you do not have all the answers today, that's fine. Sometimes the smartest next step is simply having the right conversation early with myself or Francisco. If you have personal questions after tonight, need guidance at all, or you want to map out a strategy specific to your situation, Francisco and I are always happy to be a resource. And lastly, our business is built almost entirely off of referrals and relationships. So if you found tonight valuable, if you know a friend, family, coworker, or a neighbor that may benefit from honest real estate guidance or mortgage advice, and an introduction would be greatly appreciated. So keep that in mind. And I just wanted to let everyone know that we do have some exciting news as part of our masterclass series. In case you're wondering when the next one will be, it's on protecting what matters most, a guide to life, disability, and critical illness insurance. It's taking place on Wednesday, May 27th at 7 p.m. It will be on Zoom. It's another information session where we're going to be breaking down key types of personal insurance coverage, including life, disability, and critical illness, understanding the differences between each coverage type and knowing which ones are right for your situation can make a real difference and where it matters most. And aside from that, thank you again, everyone, for your trust, your time, and your presence tonight. I truly appreciate you, and I look forward to staying connected.
Thank you
On the
guys
next
so
slide,
much.
I was going to say there's going to be our contact information on the next slide. So feel free to take a screenshot. You can reach out to myself or Francisco or whoever invited you tonight if you have any additional questions.
Thank you guys. Bye. Take care.
Bye, Kathy.